All right. Hello, everybody. Welcome back into the ETF Options Superstars program. I did want to get a video out here today highlighting our new trade from this afternoon on FXI, and then also take a look at some of our existing positions, where we stand on those, what do we plan on doing with those here in the coming days. So let's go ahead and start out with FXI. This is the 195-minute chart that you're looking at here now. I am actually going to switch the chart to a 130-minute chart. This is one of our faster time frames, one that we have just started to use here recently with the markets changing, with volatility exploding and ranges expanding. We have made some adjustments and actually come up with a new time frame that we have found works really well. So the 130-minute, we still love the 195-minute. We'll continue to use it. The 130-minute is actually looking at an overbought condition on the pulse indicator. And the pulse indicator is that red and yellow histogram down at the bottom. The yellow bars there indicate that price action is between a 1 and a 2 standard deviation channel move on the upside. In other words, we're overbought. Doesn't mean price can't move higher, just means it's not statistically probable. Normally, when you start to see these yellow bars print, it indicates that price is at a level where you'll typically see some consolidation or even a reversal in the other direction. No surprise here that we have started to see some selling today. It's nothing extreme, nothing significant as of yet, but we have started to see some signs of a near-term exhaustion point being put into play. I need 3 out of the past 5 bars plotting yellow. We have that here. When that happens, it gives me the ability to look at selling a call spread. So if we go over to the trade page, that's exactly what we did. So from the alert this afternoon, we mentioned that we wanted to go all the way out to the June options. Those are the options with 52 days left. This is going to be a longer duration trade for us here. So we went out to the June options, opened those up, and we mentioned that we wanted to sell the 42 call spread. That means I'm going to the call options on the left-hand side. I'm showing it to you here in Thinkorswim first. I'll show it to you in Tastyworks in just a moment. Let's go to the 40 call. I'm going to right-click on those, go to sell, and go to vertical. It's going to pop up an order down at the bottom. I want to make sure I'm selling the 40 call, and I want to make sure I'm buying the 42 call. So I'm going to click on the drop-down menu and switch the 41 to 42. And I mentioned from our alert, we wanted to get filled at 60 cents or higher. The mid price here is 66 cents. So just for the sake of this video, let's assume we get filled at 66 cents. And bring up the order confirmation box. You can see from the box that we are risking 134 to make 66. We're right around risk 2 to make 1. Why would we do that? That makes no sense, right? Well, actually it does. With a credit spread, you're always going to be in a situation where you're risking between 2 and 3 to make 1. We're okay with that because we have 5 ways of making money on this position. My break-even point is at 40.66. That level right there, this number right here, is calculated by taking the 40 call that I'm selling, and we're adding on the 66-cent credit that I collected to put the position on. I don't care if the stock moves up, down, or sideways. As long as it stays below 40.66, we get to make money. We also make money as time decay adds up. Every day that passes, that helps us. Time decay picks up the closer we get to expiration. That's helping us. And then the 5th way that we have of making money on the position is if volatility decreases. So now I've got 5 different routes that I can go. It's going to leave us with a higher winning percentage long-term when compared to just buying an outright call or put. The only move that hurts me is a big sustained move above 40.66. Price is currently down at 39.18. So we've got a little bit of a cushion here where price action can move against us and we're still okay. Right, so that was the trade from earlier. Anytime we use a credit spread, my target zone is 50 to 75% of my max profit. My max profit here is $66 per spread. That's what we collected to put the trade on. My target zone is between 17 and 33 cents or so. That would allow me to close it out and keep between 50 and 75% of this $66 level. Okay, and you'll always see the target levels posted on the position sheets as well. I update the position sheets every morning, so you can always see those there. If you have any questions on those, let me know. So if you have any questions on FXI inside of Thinkorswim, again, let me know. I'm more than willing to help out. Let me go ahead and pop up Tastyworks here next, and I'll show you how to place the trade here. And I'm showing you Thinkorswim and Tastyworks because those are the 2 platforms that I use personally. Not saying those are the only platforms you can use. There's a lot of other broker platforms out there. I'm just not going to be the best resource to help with those platforms. I can help with these two because I use them every day in my own trading. All right, so let me go up to the symbol box up at the top. It's that gray box, and we're going to switch the symbol from Starbucks to FXI. And from the alerts, and before we get to that, down the left-hand side, you're going to have this vertical toolbar. Click on the trade tab. And then where it says trade mode up at the top, we're going to make sure we have it selected at table. We use the curve mode, active, or analysis. We use the table mode here. Okay, so from the alert, we mentioned we wanted to use the June monthly options with 52 days left to expiration. So we're going to go ahead and click on those and open those up. If you need to open up more strike prices, you can do so in the drop-down box up at the top where it says strikes. You can click on that and load up more strikes if needed. And then the call options are on the left, the put options are on the right. So from the alerts, we mentioned that we wanted to sell the 40-42 call spread. So I'm going to come and left click on the bid price of the 40 call. That's going to box it in red, indicating it's a sell order. And then I'm going to left click on the ask price of the 42 call. It's going to box it in green. That indicates it's a buy order. We're going to do both of these at the same time. It's creating a vertical spread. Down at the bottom, in the lower left, it's going to summarize the order where you can see I'm selling 140 call. STO stands for sell to open. And I am buying 142 call. BTO stands for buy to open. You can change the quantity up in here, up at the trade page. You can left click on those arrows and change the quantity from 1 to 3 to 5, whatever quantity you want. That's fine. And then you can also change the price in the middle column there, in the middle section of the trade page. So right now it's set to 67 cents. We can arrow up or down to change the price there. Remember, from the alert earlier, as long as it was above 60 cents, we were okay with that. The order type needs to be set to net credit. Anytime I say sell to open, we want to collect a credit. And then the time in force, TIF, we want it set to a day order. Anytime it's an entry order, we want it set to a day order. The only time I use a GTC, stands for good till cancel, the only time I use that order type is if it's a closing order for a target or a stop. I want this set to a day order because if it's not filled today, I want it to cancel at the end of the day. All right. So that's how you put the position on inside of Tastyworks. Again, if you have any questions on that, certainly let me know and I can help out. Not a problem. All right, next, let me bring over the position sheet. This is the position sheet that is updated every morning on the owner site. I also post it inside of the Slack group. I separate the trades by trade type. Down at the bottom, you'll see the short call spreads, the short put spreads, long puts, long calls. That way, you can clearly go and find the trades that you're looking at. That way, you don't have to go through a big, long list of 12 positions and find the one that you're looking for. I separate them by trade type. Most of our open positions right now are short call spreads. You can see that down at the bottom, the short call spread tab here. Selling a short call spread is a bearish position. We want the stock to move lower, but we don't need a big move lower. If it just moves sideways, we're okay there as well. On the position sheet, I give you the symbol of the market that we're trading, the date that we initiated the position type, and then the exact position that we have on as well. Over to the right, you'll see the entry price that we were filled at. You'll see our position size, our target range as well. So all the information that you need on every position is updated right on these position sheets. That way, if you're wondering, hey, what is the plan of attack here? You can always go to the position sheets and see where our target zones are at. Now let's go back to the position column here. On the short call spreads, you're going to notice that we tell you the expiration date of the options that we're using, but then we also give you the two strike prices. The first strike price here, in the case of TLT, the 170 call, that is the strike price of the option that we sold. That is the key level because we need price action to stay below that level. As long as it does, we make money. So TLT, I need below 170. XLU, I need below 61. QQQ, I need below 218, and so forth. So now just a quick way to come in and see, okay, are we in trouble on this position? What should we do? It's not strictly based off of P&L. Because these credit spreads can recover much faster for us. We have 5 ways of making money on the position. The time decay is helping us. Every day that passes, even if the stock is moving against us, that time decay is adding up in our favor. And that allows us to recover faster on these positions that move against us. So what I'm going to do is drag this spreadsheet off to my other monitor, and then we're going to take a look at each of these positions and walk you through what we're expecting and how we plan on managing the positions. So I'm going to go over to the back over to the chart. We'll start out with TLT. We are short the 170, 172 call spread out in the May monthly options. I need price below 170. And actually, let me switch this back. Let's switch it back to the 195-minute chart here. So TLT I need below 170. It's just kind of been hovering right around 170-ish since we put the trade on. Take a look at where price action started to stall out here, right here, and compare that to what we're seeing down on the pulse indicator down at the bottom. See how all these yellow bars started lining up? And see how price action has started to chop sideways since that happened? Very common occurrence when you start to see price hit between a 1 and a 2 standard deviation move. All right? That's the pattern that we're looking to take advantage of. I don't need a huge move lower on TLT. I just need it to stay below 170. Even if it only stays below that level by a penny, I'm okay. The only move that hurts me is a move above 170. Okay, so now with a couple weeks left, there's nothing I need to do. I just come in, I make it sure that price is below 170. If it is, I'm good to go. Even if it moves above 170, I don't need to automatically go in and close out of the position. Because these trades will recover much faster, the only time that we really need to worry about a credit spread is if the option that we sold, the short strike, in the case of TLT, it's the 170 strike. If that goes deep in the money and we get closer to expiration, that's when we start to get more assignment risk. Right now, there's nothing we need to do. Now, it can be frustrating because you're saying, okay, the price is below my short strike, and why am I not making money? We haven't made money yet because not enough time decay has added up in our favor. If we get any type of a move lower, the P&L will pick up in our favor much faster. So you have to be more patient. I know most of us, myself included, we're not patient people these days, right? We want that instant gratification. It's not going to happen in most cases on a credit spread. You have to be more patient. They're more forgiving trades, but you have to be more patient and let them develop. I love them in this type of a market because with so many back and forth moves, they're more forgiving type trades where I don't have to be perfectly right on direction and still be okay. XLU, this is the utilities ETF. We sold the May 15, so again, the monthly options, and we sold the 61.63 call spread. I need price action below 61. Very similar pattern to TLT, right? We haven't seen a huge move lower, but we don't need it. I just need price to stay below 61. It's just kind of been moving in a sideways pattern here. We've consolidated. Very, very typical price action after a nice move. Okay, so no reason to close out of XLU. If it stays below 61, every day that passes, the closer we get to expiration, the P&L will pick up in our favor. QQQ, the NASDAQ ETF. Again, we are short a call spread, and we are short the May 8th weekly options, and we're short the 218, 220 call spread. I need price action below 218. It is. Okay, price action starting to move lower. Not in a huge way, but it's starting to move in our favor here, which is nice. I need price action below 218. If I go over to the trade page, and let's go ahead and load that one up here, just so I can show you how we plan on managing it, if I can find the right position. There it is. So we sold the spread for 80 cents or $80 per spread. We have been dead wrong. Up until today, we have been dead wrong in this position. Right? Up until today, we've had very little selling pressure on the NASDAQ. Well, the spread is currently trading for 62 cents. We're up almost $20 per spread, and we really, up until today, haven't had a directional move in our favor. This is, again, why we love the credit spreads. They're more forgiving. Now, if we get that expected move to the downside, this thing is going to really pick up in our favor. And our target zone is when we can buy the spread back for between 20 and 40 cents. Again, we're getting that range because that 20 to 40 cent range would indicate 50 to 75% of our max profit. Okay, so again, no reason to close out of the trade yet. It's finally starting to work in our favor. XLK, this is the technology ETF. Right now, we are short the May 15 monthly options, and we're short the 91.93 call spread. Again, we really haven't been right on direction yet, have we? Up until today. but we're still okay. We need price action to stay below 91. Where am I getting that 91 level from? That's the strike price of the option that we sold. That's the call option that we are short. As long as price action stays below 91, we're okay. The price, the profit will start to pick up in our favor the closer we get to expiration. Okay, XLY. This is the consumer discretionary ETF. So let's go ahead and talk about that one next. So we take a look at XLY. We need price action. We're short the 115, 117 call spread. We need price action below 115. Since we put this trade on, what has price done? I mean, it's continued to move higher, right? We've been dead wrong on direction until today, and now it's starting to move back down in our favor. As long as it stays below 115, I can make money because the closer we get to expiration, the more the time decay picks up in my favor. If we get a big move lower here, perfect. We'll recover faster. We'll start to get into profit faster. If it doesn't, if we just stay right here and don't move at all, we're okay. The only move that hurts us is a big move above 115. So we'll continue to hold XLY as well. The retail ETF, XRT, we are short the 35, 37 calls for. This one we need a little help from. We are short the monthly option, so they have a couple weeks left to expiration. We need price action below 35. It's closed today at 36.80-ish or so. So we don't need a huge move. We need about a $1.80 move to the downside over the next couple of weeks. It's still very doable. Not saying it's going to turn into a full profit, but we're still overbought, still looking for a move to the downside. And if we can get any type of selling here over the next couple of weeks, this thing will start to recover again for us. The only time that I get concerned is if we are way in the money. So if we start to see a continuation move to the upside and we go deep in the money on that short option, the short 35 call, then we'll take action. We'll either roll the position out or we'll just close it and take the partial loss. Okay, so and we'll always let you know when we're doing that. Anytime that we make an adjustment, anytime that we close out of a position, you will always know from us right away. And then finally on IBB, this is the biotech ETF. We are short the 128, 130 call spread. We need price action below 128. We did get a nice reversal today, which is helpful. Price action at 124.81. Markets are still overbought. Pulse indicator still plotting yellow and green. So there's still no reason for me to close out of the position. Like I mentioned earlier, with these credit spreads, you just have to be more patient with them. They can take longer to develop. And I know they can drive you nuts. I mean, there's sometimes you're like, well, you just move already, right? But the time decay's helping us. We can be more patient. They can recover much faster for us. And that's why we tend to hold them longer when compared to a long call or long put. Okay, so those are the short call spreads. None of them need to have immediate action taken yet. We'll let you know when we're taking action on our side for sure. We do have one long put position on IYR. Unfortunately, the real estate ETF has not rolled over like we wanted it to. Right now, we are along the 73.5 puts. And on the position sheet, I will always give you the 50% stop loss level. This one right here. If you want to use that 50% stop, I am perfectly fine with that. That's the black and white rule that you can have in place. That level is always in the position sheet from the moment we put the trade on. However, I will always let you know when I'm taking action on my side. And there are times that I will hold the position longer. I'm willing to take more risk to hold longer. If you don't like that, if that's not something you feel comfortable with, stick with the 50% stop level and you'll be perfectly fine. Okay, so I still have IYR on. I need about a $2 sell-off here at this point. So again, doable because the market is overbought. We'll just wait and see what happens here over the next week or so. And then the two long call positions that we have on SLV, we are long the 13 calls, price action at 14.10. So on SLV, we bought the options for $1.15, and let's take a look at where we're at here. It's now trading for about $1.27. So we've got a small profit on the trade so far, nothing significant. Definitely want to see a move back to the upside on silver. And you can see from this chart, we've just kind of been moving straight sideways. We want to see that coiled spring pattern that we've seen, this sideways pattern. We want to see it break to the upside. So we'll continue to hold SLV. And then finally, the problem child is USO. Energy has been just absolutely clobbered here over the past month. No doubt about it. Right now, we are long the 5.5 calls. This is one of those positions that I ended up holding longer. Okay, I held longer just given how overdone the market was. I decided to take the additional risk. If you didn't feel comfortable with that, the 50% loss, the stop loss was at 58 cents. That trade could have been taken off there. I still have the trade on. Why do I still have the trade on? Because the options are trading for around 2 pennies. There's no additional risk for me to continue to hold. So now over the next couple of weeks, if we do get a bounce in oil, maybe we get lucky. Maybe we can take a smaller loss or even a small profit. We'll see. I'm not expecting it, but it's the potential is there. What I'm pointing out is there's no additional risk here for us to hold. There's no point in us closing it out because we can't lose any more than what we paid for the option. So now if we do get lucky and do get the move to the upside, we can potentially recover. So that's why I still have that trade on. So just wanted to give you a quick update on the positions that we do have on. And then as well as the new position from earlier this afternoon. If you have any questions on those trades, feel free to send me an email, mike@netpicks.com. You can always post a comment inside of Slack or the NetPicks app as well. So I'm going to wrap this video up here. I'll be back with you guys over the next few days with our next round of setups.